Hello and welcome to the Financial Puzzle Playbook with your host, Jim Sumpter. I'm RJ Malik, producer of this podcast. So, Jim, we've been talking about the 6 puzzle pieces. And for a couple of your podcasts, you had some guests and you sort of diverted away from it. Last podcast, you went back to it. And this podcast, you're going to continue. So, why don't you take it away?
Right. So thanks, RJ. It's great to be with you today. So we are going to continue talking about a couple of puzzle pieces. We're going to touch the investment. We're going to touch the retirement. As I always say, things always go back to cash flow, and there's always a tax implication with them. And what we're going to do today is we're going to continue our last discussion where we talked about employee benefits, and we're going to continue with the investment side of employee benefits. You know, on the last show, we touched on the insurance opportunities, your FSA, your HSA, disability, life insurance, things like that. Now we're going to jump into what are these investment opportunities that we have. So we're going to touch on things like 401ks, 403bs. If you have a plan that's a simple plan, we're going to talk about Roth IRAs versus or Roth 401ks versus regular 401ks. What are some different rules? So that's where we're going to kind of touch on today and spend a few minutes. So RJ, let me ask you this: you've been with different employers throughout your career. You get there day one, you fill out all the paperwork, and then you get to these options of my benefits, and it's
Mm-hmm.
like, well, what about a 401k? Have you had that experience?
Yes, and in fact, I have 2 different 401ks now.
Okay,
One that's just sitting with our financial advisor, and then I have one with the current company that I'm working with.
great. Okay,
So I have 2 401ks. I know my wife has 2 401ks because she's worked with different companies herself. So it's something that I have to say I don't know much about. I All I've done recently is max the amount that I can put in that will be matched. So
right,
that I've done.
right.
Everything else, I'm that's just not my focus, and it's not my specialty, and I have to admit it's not something I'm really interested in, which is, I know, not a good thing.
Well, okay, so I do have an interest in it, and so let me ask you this. So you mentioned the putting in up to the match, and let's take a small step back. So you walk into a company and the company offers a 401k. What that actually is a retirement plan that you as an employee can contribute to. Okay.
Hmm.
So you're taking your money that you've earned and you're contributing it to a 401k plan, which has some investment structure behind it. We'll talk on that in just a second. You mentioned the match. What happens a lot of times is a company will offer as part of their benefits package a 401k match or a 403b match. And what that actually means is let's say you're putting in 5% of your compensation. So I'm going to use easy math. If you make $1,000 a week and you're going to put in 5%, that means $50 of your thousand is going to go into your 401k plan. And then the company will turn around and match that. So you put in 50, they put in 50. Now, you mentioned up to the max. So
Right.
let's say that you only put in 3%. So you're putting in $30. They're not going to put in 50. They're only going to put in 30. So I always tell clients or prospects or anyone I'm talking to about this, it's important that if your cash flow will allow, that you put in at least up to the match. Okay. So, we went through a big thing about cash flow in episode 3, and I talked about my 50-30-20 rule. And, this is part of that 20%. So you want to have 20% of your compensation that can go toward your savings. Well, this can be a portion of your savings. RJ, let me ask you: when you sat down and you looked at your 401k, did you have any investment choices?
I did for in the beginning, but then I had to switch because of my wife's employment.
Okay. Okay.
We're only allowed we can't invest in individual stocks.
Gotcha. Okay. Okay. So what happened is you sat down and you had maybe a list of different mutual funds that you could choose from.
Correct.
And we've talked about what a mutual fund is. It's a basket of investments. And so what happens is, you sit down and you have this list of, 15 to 30 different investment choices. And sometimes, your eyes are glazing over. It's day one. You're not really sure what you're supposed to do. I'm making all these decisions, and it's like, yeah, I have no idea. So what happens a lot of times is people go directly to, well, what's performed best lately?
Right.
And that's the one they put money into, or they put it into the money market and say, I'll deal with that later. And then they may or may not go back and deal with it. And so we've seen that happen many times before. So I'm going to touch on a little bit deeper on the investment choices in just a minute. One of the things that is new within some 401k plans is you have an option to do what's called tax deferred, or you might have a Roth option. And so what that actually is if you put into the traditional 401k, we'll go back to my example of $1,000 and you put in 50. That $50 that you're putting in is going to be pre-tax. So you're not paying any income taxes on that $50. You're only paying income taxes on the 950 of your earnings. You invested the 50 in a pre-tax basis. Now the match that comes in, that's also not taxed to you. So because that's kind of your free money from the company, and so now your account has $100 in it. Okay. One of the options that you may have is what's called a Roth 401k option. Now, what that means is that the $50 that you put in goes into the Roth 401k bucket. And you would pay tax on that $50, but here's the advantage. So that money grows tax free forever. And when you take it out at a point in time in retirement, when you take that money out from that Roth option, that money is also tax free. Whereas when you take that money out from that 401k option that you had, the traditional 401k that we're all familiar with, that money is taxable to you. So I
So it
always
goes
tell people it's important to have maybe two types of buckets. It's important to have both buckets. It's important to maybe look at, if it fits your particular situation. You might want to have some money that's going to be taxed, some money that's not going to be taxed, and have kind of both choices. The Roth, like I said, is a new option. One of the new things that happened in 2023 is that sometimes companies now can pay the match portion into the Roth, and that's your option if you want to have that happen. Now, not every company allows that. I guess that's one thing I should mention is a 401k plan is very specific to the company that you're working at. And so a 401k is generally if you have a for profit company, and a 403b is if you work for a nonprofit company. So if you work at a hospital or a school or some sort of a nonprofit organization, you're going to have a 403b. If you work for a corporate institution, Home Depot, Walmart, any myriad of other companies that are for-profit companies, they're going to have a 401k. They're the same thing, and essentially the rules are the same. Let's talk about how much you can contribute. We talked about the match a little bit that you want to put up to the match in general. The most that you can put in if you're under age 50 for 2024 is $23,000. If you're over age 50, you get what's called a catch-up contribution, and you can put in 30,500. Now, that's generally going to be over, the 5% match. So you may get, you may, make $100,000, and you can put in 23,000. The company is still only going to put in their 5%, so their match
right.
portion may be 5,000. But
Right.
your whole entire account had $28,000 invested in the investment choices that you choose, and that allows the money to grow. We talked about in episode 4, I think we talked about Jim's basics of investments, and I talked about
Yes.
the power of doubling and the power of compounding, and this is one of the best ways to be able to do that and to be able to utilize those sorts of accounts. um, RJ, are you familiar with the term vesting?
I've heard it. I can say I've heard about it.
Okay.
If you're going to quiz me, I'm going to
Okay.
fail the quiz because I think I know what it is, but I'm not
Okay.
100% sure.
So here's the beauty of this is, you and I can have this conversation. You have no idea what I'm about to ask you. So it's
I'm good with that.
so here's what vesting is. Vesting means if you were to leave your company, do you get to take that account with you?
Right.
Now, you mentioned that you had two 401ks. Okay. I'm assuming that's one from the company that you're currently with and one from a previous company. Okay.
Correct.
So that company that was the previous company, you were allowed to, continue to own that plan, but you're fully vested, meaning if you wanted to take that money and you wanted to take a distribution out of it, you can do that. It's your money. It's RJ's money. Okay. The company that you're currently working with and contributing to, that money is your money, but being able to take it out is going to fall under a different set of rules. So let's kind of break that down and see what that means. Okay.
Okay.
So let's say I like easy math that I can do in my head. Okay. So let's say you have a 401k plan that has $100,000 in it. And of that $100,000, you put in 75,000 and the company matched 25,000. Okay. The money that you put in is always yours. That you're called what's called vested. That means it's your money, you're vested in that money. The money that the company put in, what the company doesn't want you to do is only stay there a couple of years and they've given you all this quote unquote free money. So a lot of 401k plans or a 403b or whatever the case may be, they may have what's called a vesting schedule, which means that the longer that you're at the company, the more of their money becomes yours. So let me explain. So of that 25,000 that they've matched, okay? So if a lot of firms will have, say, a 5-year vesting schedule with 20% each year, okay? So if you're there 1 year, then you're going to be 20% vested in the match, meaning if you leave, the money that they put in, you can only take 20% of it with you.
Oh,
At the
okay.
end of 2 years, you can take 40% with you. At the end of 3 years, 60% with you. They are incenting you to stay with their firm for at least 5 years on the benefit.
I got a question then.
Yeah, absolutely.
What if they fire me after year 2
It doesn't matter.
or lay me off?
Yeah, yeah. Well, let me put a caveat in this.
Okay.
There are some rules if you're part of a union or if you're part of a collective bargaining agreement
Okay.
that you could become vested. But if they fire you and they lay you off and you're in an at-will state like Alabama is,
Right.
then yeah, that you're
You're out
vested in the portion that's yours.
you're out of
Yeah.
luck. Okay.
Yeah. That's a great question. It's a great question. Um, so let's talk about kind of how do you get your money out of your 401k plan? Okay, so there's this magic age of 59 and a half. Now I'll be very honest. I have no idea who in the world ever came up with an age of 59 and a half as a as a retirement age, but that's the rule. Okay. So as long as you hold that money in that account until you're age 59 and a half, when you take a distribution, there's no penalty. It all comes down to, is there going to be a penalty to take it out? Because the government, when they created this under Section 401k of the IRS code or under Section 403b of the IRS code. That's literally the code section that allows for these plans. They came up with this number of 59 and a half. And so what it does is it says, okay, I've reached, 60 years old. I want to take some of my money out. I'm not going to get a penalty to take that. It's my money. There's no penalty.
But that money will be taxed if it's a regular 401k.
If it's a regular 401k, it's absolutely taxed. It sure is. Now, if it's a
I'm paying
Roth,
attention. I'm
yeah,
listening.
you're paying attention. Yeah. If it's a Roth 401k and you take a distribution, then it's not taxed.
Okay.
But here's the thing. If it's a Roth 401k, you take a distribution before 59 and a half, it's not taxed, but you could have a 10% IRS penalty. Okay. So it's a 10% penalty plus your tax. So let's say that you're in the 20% marginal tax bracket and your state is 5% marginal tax bracket. So that's 25 plus a 10% penalty. You could be taking and paying 35% tax and penalty on money. So this is absolutely not a savings account. And I encourage people all the time, please don't treat it like that. Yes.
Okay. Question, what about, if I then move to another state, for just the example, I live in Jersey.
Okay.
So there's a state income tax.
Yes, a very high one.
Thanks.
You're welcome.
Now, if I retire and I move to Delaware, where there's no state income tax.
Right.
And I start taking money out of my 401k, am I paying a state income tax?
Yeah, it's a great question. So you're going to pay tax in where you are a resident when the distribution is completed.
Okay.
So, so let's say you moved from New Jersey to Delaware, or from Alabama to Florida, or Alabama to Tennessee, or California to Texas, because we're seeing a lot of these types of moves. Okay.
Yes.
In the middle of the year. Okay. So the distributions that you take January through June are going to be taxed at your state of residence when you were there. And then the distributions from, say, July to December are taxed at the state of residence, but it doesn't have a state income tax because that's where your residence is. So that's the way that the state part works. The federal part does not change. Yeah,
they got you no matter where you are.
They're gonna get their piece no matter what. That's right. That's right. But those are great questions, and it's something that you definitely have to consider, because if you're transferred, or if you move, or you retire, or somewhere like that, if you retire to one of these low or no tax states, this can become a really big deal, because what happens is, people have saved money into their 401ks for years and years, and they've gotten the match, and they've gotten these doubles, and it's been invested, and they've grown these accounts, so they have these big balances, and that's what they use for their retirement money. Well, in retirement, that's considered income. Yeah.
I have another question.
Okay.
What if my wife and I, spend just under 6 months, and we live in Cape Cod, Massachusetts?
Okay. Massachusetts. Okay.
And then we spend another little more than 6 months in Delaware. And that's where we say that's our home address is.
Okay. So,
are we going to pay state taxes in Massachusetts?
Yeah, so that's a great question. We're kind of getting into state of residency rules.
Right.
And so there's a term called nexus. And where you have nexus is where your residence could be. And I'll tell you, as a general rule, the things that could qualify you for being able to say, I live here or I live there, is if you have claimed homestead in a state, where is your car registered? Where are you registered to vote? And what state do you have a driver's license from?
Okay.
Now, one of the other things that I will tell you, that if you get into an audit that is being looked at, is if you say you live, and I'll give you an example that I heard is someone that lives in Michigan but owns a place in Florida. Okay. So they have homestead in Michigan, but they say that they were in Florida for, 6 months of the year, but their power bills in Michigan have been reflected that they actually paid a pretty high power bill for 9 months of the year.
Okay.
And they paid a lower power bill in Florida for 9 months of the year. And so in an audit, a lot of times those are the types of things that are being looked at. But the general rule is your homestead, driver's license, car tag, and where are you registered to vote.
Okay.
But these are all great questions because this is happening a lot where people are kind of moving around the country and things of that nature. I will, I mentioned that there's this penalty if you take out money, what I call early. Now, there are some exceptions because most IRS codes have exceptions. Okay. So if you were to become disabled, if you were to need money for exorbitant medical expenses, if you were to go back to school for earning a degree for an higher institution of learning, education purposes, if you were to buy a first time home and you're a first time home buyer, you can take up to 10,000 in some cases at a plan. So just because you think you might have a penalty, you always want to talk to your advisor or your tax professional and say, but do I have something that qualifies me to be able to take this money out? There were some very extenuating circumstance rules during COVID. If you've experienced, if you're in an area, we had a hurricane last week in Louisiana. So if you're in an area that's damaged by a hurricane or wildfires or any natural disaster, those are things that can be exceptions to rules. So it's always very important to look at what are my exceptions that I may qualify for in order to take money early. Now, I'm going to go back to my statement I made a few minutes ago, though. Let's don't use this like a savings account because this truly is, a retirement account. And I will tell you, we're going to talk on the next podcast. We're going to talk about what happens if you inherit one of these things. Um, and what happens if you inherit it as a spouse, or what happens if you inherit it as a non spouse. So, if your mom and dad pass away and you inherit a 401k, you inherit an IRA, you inherit an IRA, a Roth IRA, what are some of those rules?
Hi everyone, I'm Cassidy, the second C in CMC Financial. So Dad sometimes gets on a roll with this podcast and might forget to remind you about a few things. One, don't forget to like and share this podcast and leave a review. Two, follow CMC Financial on all of the socials, Facebook, Instagram, and LinkedIn. And three, go check out the website at cmcfp.com. Okay, back to my dad. He's probably still talking.
All right, so let's jump in and talk about just a couple of other investment things within these 401ks and within these benefit plans that your company may offer. And so let's talk about the investment side just a second. I mentioned a few minutes ago that the company is going to give you a myriad of investments. It's the investments that they've chosen with their investment manager, and those are your choices. And so, you may have a large company stock, a small company stock mutual fund. You may have international, you may have some fixed income, you may have, this type of bond or that type of bond. You can certainly choose, a percentage of each of those, and you can create your own model and everything like that. What a lot of companies also have is they have these funds called target date funds. And so many 401ks in today's world will have a target date fund that says maybe a 2025 target date, or a 2035 target date, or a 2050 target date, or a 2060 target date. What that is doing is that target date is your target retirement date. So, what that actually says is if you invest in a 2050 target date fund, that is going to be a more aggressive investment than the 2030 target date fund, because 2030 is a 6-year window, whereas 2050 is much greater than a 6-year window. 2060 is, you have a 36-year window. So if you're, 22 years old and you're going to have a 36-year time before you can retire, you may want to invest in that 2060 portfolio. Whereas if I'm, in my late 50s or early 60s and I say my window is 5 to 6 years, then I may want to be in a more conservative portfolio. So what the target date funds will do is they will choose a lot of different investment choices and become either more conservative or more aggressive in their investments based on that date as the retirement goal. And so a lot of people, and this is what I encourage people to do in the beginning, you walk in day one, you fill out your form, put in at least up to the match. And, so you're at least going to get that portion of money. And then, if you just don't know, choose a target date fund for when you're going to turn 65 years old and start there. Start with something. You're putting money in, you're getting the match, whether it's in the traditional 401k or the 403b. I mentioned simple IRAs. If you work for a municipality, you may have a 457 plan. There's all these different types of plans that are available, and depending on the type of company or place where you're actually working. So that's the investment part. The last benefit that I'm going to mention is an employee stock purchase plan. Now, not every company offers this, but a lot of companies do, especially if you're a publicly traded company. So I'll tell you a quick story. I have a client who works at Home Depot. She's in the design for, I believe it's the bathroom area for Home Depot. And she has, as part of her benefit, and what's called an ESPP, an employee stock purchase plan. What she's able to do is put money every paycheck into an account that quarterly will go and buy Home Depot stock for her at a 15% discount. So if Home Depot is trading it's trading in the high 200s, 300s today, but let's say Home Depot is trading at $100 a share, she's going to be able to buy those shares at 85 because she's able to buy them at a 15% discount. Now, she owns those shares. She's going to earn the dividend on those shares. There's generally not a time frame that she has to hold those shares. It's just a benefit that she can buy them at a discounted price. So I always encourage you, as you're going through your benefits package, you look at your insurances, your life insurance, your disability, your medical, look at the FSA, the HSA, all the stuff we talked about last time. Look at your investment choices, the 401k, the 403b, do you have an ESPP? Are you a type of employee that's going to get incentive stock options, non-qualified stock options, restricted stock? These are all benefits that you could get. That I always encourage you, talk to your advisor about, talk to your tax professional about, because what happens is all of these benefits are wonderful benefits as long as you follow the sets of rules that allow them to be such good benefits. And RJ, that's really what I wanted to cover today. We've gone through all of the benefits, options that you could possibly have. Companies are always getting creative. They're going to come up with more benefits over time. And you have to look at that. During your open enrollment season is generally when you can change, or if you've had a life event. So if you've gotten married, gotten divorced, had a child, had a death, things like that, that becomes a new life event. So, okay, I've covered a lot. You got to ask some questions, but what's your, I'll give you one more question and then we'll jump off.
Okay. As far as the different options, you really need to talk to a financial advisor as far and what's best for you. Now, can a financial advisor talk to your company that you're working for?
Sometimes, yeah, sometimes I've actually done some presentations at companies. If the advisor has a relationship with someone in HR,
Okay.
then generally they can get in. You brought up one good point, and I'll mention this: the advantage of working with an advisor. You mentioned that you have a 401k currently.
Right.
Your wife has a 401k currently.
Right.
You have an old 401k. She
Hmm.
has an old 401k. Y'all have other investments. I talk all the time about putting your financial puzzle together. If you just stop at the investment part, okay? If you have a target date fund, your wife has a target date fund, or maybe you have taken and you've allocated out the different investment choices. What you don't want to do is be buying the same thing in every single account, or at least be aware that you are or aren't, and be diversified, because you don't want to have the same thing in all of the accounts. I have a client that works at a local bank, and part of his 401k, he has the opportunity to buy his company stock inside of the 401k.
Right.
Well, he wanted to allocate 10%. Okay, so he's allocating 10% of his company stock into his 401k, 90% into other investments. What we don't want to do is have other investments that are overweighted in his company stock, because then his overall allocation could be much greater than the 10% goal. And so it's always important to talk with an advisor to get inside of what is it that you own. Every mutual fund investment has a ticker symbol. And you can look up those tickers, you can see what the top 10 holdings are, you can see how it's allocated, you can see how it's performed, you can see what the fees are, see what the expenses are inside of that, every one of those investments. And I encourage people to do that. Sometimes people want to do it on their own, and sometimes with an advisor.
But you shouldn't do it too often.
Well, no. What you don't want to do is be changing all of the time, as far as your allocation. Now, one thing that I do like to do is I like to rebalance, at least twice a year, or when we've had a very large move in the markets, either up or down.
Okay.
Because what happens is you have this allocation or pie chart, okay, and every piece and sliver of the pie has a certain percentage. Well, if everything always goes up at the same time or always goes down at the same time, you're not diversified. Okay, so while one is zigging, you want the other to zag. But you want to, over time, have the whole account grow. Obviously, we
Right.
don't want it to be stagnant or not grow. But you want, when you're allocating a portfolio, and this is what those target date funds do, is they may own 15 different funds. Well, they don't all move at the same time. Well, what happens is you get one that just absolutely takes off and does really, really well, or one or two. And then you've got some that underperform. So when you rebalance, what you're doing is you're taking profit from one, reallocating that to the one that didn't do as well, with the hopes that that will shift and will turn, and maybe you get exactly the opposite. So that's all rebalancing does, is get your portfolio back into the percentage that you want based on your overall risk tolerance. See, that's the other thing. And, we've talked about this before, as your risk tolerance. Even though this is a 401k, it's still an investment.
Right.
And whether
Right.
it's in the traditional IRA or the Roth IRA bucket, it doesn't matter. It's still an investment. And so you want to be able to allocate within your risk tolerance, within your comfort level of investing. And many times, you may be one way and your spouse may be another. Jennifer and I are not the same on our investment structure.
That's
Um,
interesting.
yeah,
I would never think of that.
yeah,
What you just
yeah,
brought up, I'm like, wow, that's something not in my world.
yeah, because and so, you want to invest your money the way it's comfort to you, and your wife invest hers, it's what's comfort to her. But at the same time, you're also one family.
Right.
And so you have to look at things, in my opinion, you look at everything together. Now, there are clients that keep money separate, and that's perfectly fine if you do. There's nothing wrong with that, as long as you're not both working towards a common goal that buckets of both monies are going to be working towards.
Right.
And so again, I'll go back to everybody's different. Everybody has a puzzle. Every family, every person, everybody's a little bit different. And so this is something that comes up every year, every new employer. I've got a client that used to work for a company. He had a 401k. He left the company. He now owns his own business. Okay. So now he has other retirement choices that he has to make. And so he's looking, what are his options as a small business owner that he also has, and we can help with all of that as well. Now he doesn't have the plethora of the benefits that he had when he was an employee, but he has other advantages as a small business owner. So you have to look at the whole thing and make adjustments and changes, but it still comes down to some of those simple principles: saving that 20%, putting money in, getting that match, investing appropriately with your risk tolerance, working with an advisor or your tax professional to make sure that what you're doing is the most appropriate thing for you. So I'm going to wrap it up with that, and then I'll put a plug to our next podcast, which is, okay, now you inherit one of these things. Now what do you do? And that's what we're going to talk about next time.
Sounds good. But we also need contact information.
We do. Okay.
How can people get in touch with you?
All right. So I have my office phone is 205-510-9074. You can call or shoot me a text. CMCFP.com is our website. And we are on all of the social media channels, Facebook, LinkedIn, Instagram, and YouTube.
Excellent.
So that's how you can get in touch with us.
That's fantastic. All right. And most importantly, thank you for listening to the Financial Puzzle Playbook podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at the Financial Puzzle Playbook, I'm RJ Malik, and we'll see you at the next podcast.
Thank you for listening to the Financial Puzzle Playbook. Click the follow button to be notified when new episodes become available. Don't forget to follow us on social media by checking the links in the description. And contact us today by visiting our website at www.cmcfp.com or give us a call at 205-510-9074. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of CMC Financial. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by CMC Financial or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, CMC Financial, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.